And Vice Chancellor Laster gave us a nice segue as well, because we've talked about enforcement in the public company context. And as you go lower and lower, not for every private company, but for some private companies, they're a little smaller. Some are quite large. And I will turn it over in just one moment to my co-author, Professor Elizabeth Pullman. It's okay. I see, okay. So why don't we just, for people who are online, can we just take a 1-minute break and we'll come back? Oh, she's ready? Okay, great. That was my most effective stalling move. That's all I got for those of you online. Sorry.
That last panel was so terrific, and today has been so wide-ranging. I'm Elizabeth Pullman from Penn Law.
I'm David Zaring from Wharton.
Enrique Abeda from Empire Financial Research.
And I was reflecting back on something said in an earlier session from the journalists about how sometimes they work upwards of 18 months before they will definitively say something that might use the F word of fraud. And I was thinking about our session, and we're going to talk about detecting fraud in private markets. And this is an especially challenging context in some ways because there's a range of activity in this space that might not be fraud. There's puffery and aggressive tactics, and we want to be real clear about that, that some of what we might talk about is not fraud. It's part of a context of a day called Fraud Fest, but that involves a lot of different activity, from stuff that's, not fraud to potential fraud, alleged fraud, activity that might be investigated, actual guilty verdicts, and so on. So we'll try to be precise, but we're going to talk about a range of stuff, and I'm not sure who's going to say what, so this could get quite interesting. Also, this context is especially known for the fake it till you make it culture and hype. So it's hard to know the extent of the problem. So we're going to talk about these issues, and there's lots to discuss today. We thought we would start with startups. And of course, the big recent news is the Ramesh Sunny Balwani guilty verdict. He was found guilty on all 12 counts of wire fraud and conspiracy to commit wire fraud stemming from his time at Theranos, the blood testing startup. So that verdict is the second conviction against Theranos leadership and comes about 6 months or so after the jury found founder CEO Elizabeth Holmes guilty of fraud. It secures a win for the Department of Justice, which brought the case against the pair in 2018. Their sentencing is still ahead, but it largely brings to conclusion one of Silicon Valley's notorious startup implosions, which evaporated hundreds of millions of investor money. So I wanted to start the three of us chatting around what's important to understand about the Theranos guilty verdicts, and was Theranos an outlier? Let's start with you, Enrique.
Sure. Well, thank you, Elizabeth. Thank you, everyone. I apologize for my informal attire. I wore a suit for 25 years because I was a very active short seller, and I found it to be better, but now I don't have to. Look, I think the whole private world's quite interesting when we talk about the concept of fraud. When I think of the word fraud, and I don't have the dictionary in front of me, I think of making a false statement, but making a highly improbable statement could also be deemed making a false statement. The very nature of venture investments, where people are saying, I'm going to take a company that is earning zero in revenue and turn it into a company that is earning billions of revenue, statistically is a highly improbable statement. So to a certain extent, the entire venture capital community, especially when you get into the, let's also do a spectrum. When you talk about private investments, there's private equity, which is looking for 2 to 10 times their money. And then there's this other hardcore venture that says, if I'm not going to get a 100-bagger, I'm not even interested. Well, by its very nature, anything that you're looking at that you think is going to be a 100-bagger, probably 95% of them fail. So if we go into 100 investments and we know 95 of them are going to fail, yet all 100 of them are saying they're going to succeed, you get this very interesting spectrum about what is optimism and what is fraud. And the only last thing I'll add here, it's been interesting. I started in 1996. I was one of the first subscribers to TheStreet.com. Heard Greenberg and I go way back to all that time. I was one of the first subscribers to CIFRA, which was forensic accounting. Back in 96, there used to be a lot of accounting frauds in the public markets. One of the commenters made a comment about there being less persecutions today. I actually think it's because it's a lot harder to pull off a fraud in public markets. One reason is the darn internet. When I started, we didn't have PDFs. We barely had email. And so I think what's happened, you've seen two things. Number one, the private markets, relative to the size that they were, have literally grown 100-fold. And number two, in the public markets, you kind of can't get away with it as much anymore. / there's a whole bunch of companies that moved into the private markets where no one's checking anything. The SEC has only recently started agitating in this area. So again, I think to a certain extent, the entire venture world is rife with fraud almost everywhere, if we define fraud as making improbable statements. So perhaps fraud, but not illegal. That's going to be the line.
Yeah, that's something I noticed about the Holmes and the Balwani trial. After Elizabeth Holmes was convicted for the Theranos fraud, then there was a little talk like maybe DOJ and the SEC are going to move into policing fraud in the private markets more rigorously, that the fake it till you make it culture of Silicon Valley is going to be a subject of more. And I think we haven't seen that so far. I don't know if it will happen, but so far it's just those two. And I'll note that if one of the things you want to do when you're regulating fraud is compensate the frauded investors, in Theranos, that's proven to be very hard to do. The investors who were sophisticated, so maybe they had it coming. The investors in the Theranos scheme tried to put together a class action. They didn't use federal securities laws. They used California corporate law. And the court threw out their putative class action on the basis that the investors had received different information about Theranos, invested in the company in a bunch of different ways. And this feature of that startup culture is a broadly shared feature among lots of startups who raise money at different times with different sorts of disclosures, putting together a compensable class of investors something that's very difficult to do. The final thing I'll say is, kudos to the Department of Justice. They went 12 for 12 on their counts against Balwani, 4 for 12 against Holmes, so they're learning. None of those counts were securities fraud claims. This is all using that federal workhorse, the wire fraud statute, and that was, I think, 10 of the 12 claims in the indictment plus 2 conspiracy claims. The wire fraud statute is being the subject of some question by appellate courts and the Supreme Court itself. And so we'll see how long that statute can serve as a vehicle for the kinds of prosecutions that we saw with Holmes and Balwani.
I've been watching this space for a bunch of years now, and I noticed with Theranos that a bunch of respected VCs really tried to distance themselves once this was really underway in the media, and pointing out like, oh, not a lot of real name brand VCs were in on this, et cetera. And there was a definite distancing to try to make Theranos an outlier, and in some ways it is. And some people would point to the medical device issue and this was mentioned earlier today as well, that when you're really hurting people that are stakeholders outside of a sophisticated investment group, that gets noticed, especially when you're not a software company, but like doing medical work on patients. That may be a distinctive factor, but I think what Enrique is getting at is that there is a level of, I'm not sure if it's pervasiveness, but it is both an outlier and not an outlier that makes it so interesting, I think, in some ways.
Well, when you just look at how many companies just fail, I mean, I have a funny anecdote of friends of mine who used to be on the sell side for many years, started a venture firm last year, about $100 million firm, and I had lunch with one of the guys last summer. And he said to me, he goes, you know, we've invested in 9 deals and all 9 companies missed their numbers within a month to 2 months of us investing in the names. And then he proceeded to tell me that almost every one of them at the time, now because we've had a VC bubble, was about to do an up round. So, but you know, like I actually run a private company in e-commerce. We pride ourselves on beating our numbers. You know, so again, you know, what is this? What if you're running a publicly traded company even, and you put out guidance and you consistently miss it? Either you're inept, or perhaps you're engaged in some nefarious activity. But I think in the private markets, it becomes almost the norm. But I think, David, you brought up an interesting point about what will the enforcement be. I think that, you know, historically, I went to Wharton as well, and I went to school with Greg Milken, Michael Milken's son, and Michael's been a big supporter of Wharton across the board. You know, when you look back at what happened to Milken, he wasn't necessarily doing anything illegal. There just weren't any laws on the books at the time to deal with what he was doing in the high yield market. And I think that, you know, the financial markets move well ahead of anything the regulators could possibly do. And I think that's what you've seen with 100-fold growth in venture in the last 30 years. We just had never seen this, certainly at this scale. And I know we're going to talk about this later. That's before we even touch on the whole concept of cryptocurrency and, you know, what that involves, which, you know, we've never seen a $3 trillion market evolve in 24 months and turn into a $1 trillion market in 12 months, you know.
I have to thank our organizers for putting this session in the day, detecting fraud in private markets, because I think in years past it wouldn't have received this kind of focus, but now there's so much to talk about. And in fact, David, I think the SEC has had, I've been watching this, a slight uptick in enforcement actions in this space, if not, you know, like referring to DOJ and having trials, but there has been a little bit more of investigations of private startups. And I've also noticed journalists covering more. So I've seen in even just the past few months through the spring, more pieces in the New York Times, Washington Post, Bloomberg about startups that have, and to the theme of detecting, have had some pathway towards there being some light shed on the question that they might be stretching the truth of something. And this is coming from a range of people. Sometimes customers are raising the issue themselves because they see the claims that the startups are making about how much tech capability they actually have or what they're doing for customers. And when customers realize that's not actually the reality, sometimes they're speaking up. Sometimes they're even suing and getting settlements and getting a stake in the company itself, I've seen. We've also seen just more coverage of the startup stretching the truth. So I think we're seeing a bit more. But this leads to something Enrique said, I think, which is that we're also in a changing environment, though. So what do you think the current downturn or chill in startup financings will mean for what we're going to be seeing in coming months?
Yeah, I mean, in some ways this may be something that Enrique said better, but one problem and one reason why you need the customers to come forward and people like that is because VCs themselves don't have a real good incentive to police companies for fraud. For starters, it's embarrassing if some entrepreneur took your money. You don't necessarily want to. We're dumb.
And many of them are on the boards, by the way, so they may have actual legal liability.
Right. So. Also problematic. And then the entrepreneurs themselves. Again, there's this fake it till you make it culture. So you need some sort of like different kinds of ways into this space, given that there's a sort of culture in the private markets, the startup-y markets of omerta. It wasn't fraud. We weren't defrauded. We knew enough. So, okay, how do you get there? Well, one place might be the SEC, which has got a cyber unit now. It doubled the size of its cyber unit, which is like okay. It's adding 20 lawyers, which brings it up to 50. I'm in the less mathy part of Wharton, just to be pretty clear. That's about double, right? So you've got people from the government looking in on this place. You've got new startups in the new space, like The Information, that looks to cover Silicon Valley very closely and doesn't want to necessarily treat its readership as sort of like a vehicle for rah-rah venture capital or something like that. And so those kinds of new investigatory sort of outlets might be another source.
I think where you also could likely see it are the investors. Right, so all those VC and private equity guys, they're all getting money from CalPERS, they're all getting money from New York Common, and you know, so far those folks haven't been bag holders. They've, you know, I don't know if you saw CalPERS sold, I think, $6 billion worth of private investments at a discount last week. You know, I think, again, when I think back to high yield, when I think back to mortgages, when I think back to savings and loans, I'm just going through all these big bubble frauds where there was fraudulent activity, but almost by its very nature, what was happening was kind of fraudulent. You know, again, if we say improbable statements are being ahead of the law, it really just came to scale. So what's interesting to me, we've been arguing that there's a VC bubble that's been happening for the last, you know, 4 to 5 years. You know, with tightening financial conditions, do you see 2 million layoffs of high-tech workers in Silicon Valley because we have 1,000 enterprises that are VC backed that are fundamentally not economically viable at this point? I'm honestly kind of 50-50 whether that happens now or 3 years from now, but I think when that happens, it's when you have the bodies floating in the water that the SEC and the investors all seem to wake up and say, oh my, there's 100 bodies floating in the water, what the hell happened? We got to write laws. And unfortunately, and look, that's just kind of the nature of the beast. Eventually the laws get there. For this very same reason I said we don't have as much fraud in public markets today, eventually they figured it out, you know, and it's just, it can be a violent process sometimes.
Yeah, though, to be clear, the anti-fraud provision of federal securities laws applies to public companies and private companies. And as we heard in the earlier panel, there are a number of different state law claims related to fraud that exist. So perhaps, you know, we have laws for this, but perhaps the enforcement might look different, or there might be more reporting on this, or more people coming forward to say things.
Right. I mean,
Yeah.
there's, you know, if the value of your thing is going up in value, then you don't have an incentive to complain about, you know, how it was sold. So, so that's just one aspect of the downturn, which seems like it would
come to the investors. You know, every investor wants to get into TCV and General Atlantic, et cetera. The last thing they want to do is go sue one of their portfolio companies. You know, it's all one big club, but it's all one big club when it's going up. At some point it goes down, and you know, I will tell you, like I know a number of venture capitalists. I mean, I have a buddy of mine who I was trying to get on this panel who wouldn't do it because no venture capitalist is going to get up here and say, yeah, most of what everyone's doing is BS and where it's all a bubble. Surprise. But he's sitting on a fund, you know, $80 million. They're not doing anything in fintech. He's literally just said, nope. I'm just going to sit it out. But he's the exception, not the rule, because, you know, if you're a venture capitalist, you don't get paid to steward capital in cash in a bank. You get paid to make venture investments. And in fact, if you're wrong by 3 to 5 years about the bursting of the venture bubble, you will no longer get paid at all because no one's going to give you any money because you missed the 5 years. So there's almost an agency risk that venture investors get paid to make venture investments, whether they're good investments or not. And it creates what is fraudulent, like, you know, activity or sensibility, perhaps.
So thinking about the detectors again, I just want to go to the board because David, you said something which I've said in something that I wrote, which is that you would think the VCs might have a lot of incentive to be strong oversight providers because they've got money in the company, but often there's other incentives going on. And Sequoia, India, and Southeast Asia had an interesting post this past spring because a couple of their portfolio companies had some allegations of some kind of misconduct or fraud going on. And this VC said, you know, that the board, well, what they said was, as an investor representative, one serves on the board, and boards can only work with the information shared with them. The less transparency there is to the board, the lesser their ability to unearth errant behaviors. And the board is there to govern and help make decisions in the best interest of the shareholders. The board is not responsible to investigate on an ongoing basis unless something is formally brought up with them, which is often through a whistleblower, which I thought was really interesting as somebody that thinks a lot about governance and whether that's actually, you know, it's not how I would phrase it. But it does, I think, really highlight how difficult it is for investors who also have a seat on the board. And it raises this issue of what venture-backed boards should be thinking about and what type of expertise should be on these boards, because there is a bit of a mismatch at some level because, of course, most venture-backed startup boards don't have any or many independent directors, they may not have financial or accounting expertise or the type of composition that you might hope for if you were expecting the board to play this kind of oversight role. So do you think that the board plays a detective function or oversight function, or do you think, just to circle back to something earlier said, do you think that that's the board's role?
Yeah, I mean, I'm no expert on Delaware law, but I don't think there's a difference between public and private companies as far as board duties to stockholders. But I was going to throw the question back to you in that when I think of what boards look like at private companies, I sometimes think, are these guys possibly going to be fit for purpose? Because you've got a bunch of owners and then a bunch of experts who are kind of like consultants, is this thing going to work? Rather than sort of representatives of some sort of outside interest. Do you think that I have that model wrong? I worry that private boards are just so different from the boards of publicly traded
Historically,
companies.
though, we've seen things like this. We saw it in the public markets, and what happens is it goes bubble burst, investors sue, some board members get sued, go to jail, or get otherwise prosecuted or very inconvenienced, I guess would probably be the major way it goes down, because none of them go to jail. And the next thing you know, they start thinking a lot more about the board that they're serving on. Because I know people that were on public boards 20 years ago and that are on public boards today, and there's a much different view of what it was. 20 years ago, it was like, oh, it's the club, and today people are like, okay, what am I getting involved with, because there's been enough blowback. I think we just haven't seen that in the private markets yet.
I think it's a time when people are starting to have these conversations about what the right composition is for private company boards, and also what the information environment is for these boards, and how to make a richer information environment, because this is something distinctive about the private market space, which is they don't have a stock price to be watching, and there won't be the kind of private class action enforcement, at least not on a regular basis, that you would expect to see. So the board does have an important role to play. Let's turn to crypto, fintech. There's such a variety of tech and spaces. So what are the key developments that we should be keeping our eye on, David?
Right, so I was
trying to... This straddles private and public markets, but let's,
Trying to avoid defamation here, I was thinking about, what are the 3 representations that crypto companies are running into trouble making? So one is, the question is, are you adequately capitalized? If you're a sort of quasi-bank, a stablecoin like Tether, what exactly are you holding that guarantees that we'll be able to get a US dollar in exchange for a Tether dollar? Tether is more disclosure-oriented than our many stablecoins, because it has agreed with the New York Attorney General to file quarterly reports by its accountants describing what it is it's got backing its stablecoin. And it filed a report late, 2 months late, but it filed a report on May, which indicated that, among other things, Tether holds $20 billion in commercial paper of some A-rated grade or another. So that sounds okay, but the question is, whose commercial paper are you holding? Is it commercial paper of Chinese construction companies? Is it commercial paper of U.S. Steel? Or what? And we're just not getting answers to those kinds of questions, even with this overlay of New York Attorney General supervision. And then a second kind of representation is, will I be able to get my money that I leave with you, a crypto broker, on demand? Here I'm thinking about Celsius and Voyager, which are 2 sort of crypto custodians who have freezed the ability of their customers to get the assets they deposited with Celsius and Voyager back on demand. One, Voyager's now gone into bankruptcy. And there were lots of representations before the collapse of a stablecoin called Luna that deeply affected both of these companies, Celsius and Voyager. The representations were very much along the lines of, you can get your money back wherever you want, we're better than banks, and also direct representations, we have no exposure to the Luna Terra stablecoin collapse. So that sounds bad, right? But we'll see if that amounts to fraud or if that was like a Lehman Brothers. We're adequately capitalized until there's a market collapse and all of a sudden we're not. So remember that no Lehman Brothers executives went to jail for representing up to the weekend before they shut their doors that they were okay during the last financial crisis. And then a third kind of representation is, will this Ponzi coin go to the moon? And there are lots of representations that, it's going to be great. And those are getting prosecuted to some degree by the SEC. It's brought in about 15 enforcement actions during the Gensler SEC, which either allege that these sorts of representations were totally fraudulent or that they involved selling a security that wasn't registered with the SEC beforehand. So we have no idea whether your representations are truthful or not. And so that is getting policed. It got policed during the Clayton SEC. These Ponzi coins, I guess, have been a subject of enforcement action in the crypto community. So those are three kinds of things that are being said in crypto land, mostly private markets, which raise questions as to their accuracy in certain cases, and that might be the kind of thing that a bunch of people interested in fraud might look at.
Yeah, I think Voyager could be a watershed event because it's very distinct. Voyager was a publicly traded company. There were multiple public statements. We actually had the CEO on a podcast, and again, I'm not saying there was any fraud at Voyager, let me be clear. I'm not making that representation, but there were very strong representations. And Voyager gets back to what I was saying, going back to my Milken example, is I don't know when you make representations about made up money and guarantee a return on made up money, are you making a false representation? Well, we're not talking about US dollars or Japanese yen or anything like that. So you're kind of offering funny interest rates on funny money. It becomes a little gray. But I think with Voyager, the other thing I would say, going to your Lehman example, there were no brokerage accounts at Lehman. Lehman was all institutional. There are hundreds of thousands, I think there's actually like 1 million or 2 million accounts at Voyager. That starts to get SEC attention real quick. So I'll be very surprised if there's not a material SEC action around at least Voyager, again, because it was publicly traded as well. So that's the difference. Every single other company you've mentioned, there's been no publicly traded exposure. Now it was listed in Canada and all that, but I don't think it was actually based here in New York. So I think that'll end up being a watershed event that we're going to hear a lot more of in the next 3 to 6 months.
Fascinating. Okay, we're in our last minute. So last thoughts, points of emphasis, predictions. Start with you, David.
I just think that compensating investors who have lost money in these kinds of situations has been hard to do. People have tried to do class actions at the state court level, some at the federal court level. Haven't seen a lot of success for these private company class actions. And if you worry about compensation for investors, then that seems to me to be a real gap in sort of a legal remedy for people at any level to recover against these crypto schemes and scams because of the difficulty of assembling a class who's received the same amount of information and suffered the same kind of misconduct.
Enrique?
I don't think anyone's going to get any money back almost any time, but I'm actually also one of the most optimistic people you've ever met. I think this is just part of a natural process we see in financial markets. I think that when we look back, and I don't know when this VC bubble really hits the skids, but it will. Crypto bubble kind of already is. Crypto bubble feels like it inflates every 4 years and pops every 4 years, so it's kind of on hyperspeed. I think when we look back in 5, 10, 15 years, there's going to be, good regulation on these markets, just same way there is the high yield market, the same way there is with Reg FD, et cetera. It's just, by its very function, the regulatory function can't be ahead of this. I mean, no one can be ahead of it. Who the hell would have ever thought of Celsius? NFTs, if I would have pitched you that 3 years ago, you would have thought I was a crazy person. And now there's billions of dollars flying around in it. So it has to be reactionary by its very nature, but eventually it works out. And I think there'll be better protections, whether people get their money back or not. But I think people are going to be less likely to get defrauded in the future. Right now, we might still be in the middle of it.
I'm not sure we're in a VC bubble, but we're certainly in a little bit of a downturn. And my bigger picture view is that I think you're right that the private markets are much bigger than they had been in the past. And so big picture, it's important that journalists are covering this. I think it's important that like VCs, like I mentioned, are out there talking about it and being willing to say we need some better governance, even just some more internal controls and maybe some more outside auditing and those sorts of things I think are great. And I tip my hat to saying good for talking about it, good for doing more. And I think that what we're doing with FraudFest is also excellent to shed light on these things. So I think the organizers
We need
as well.
CalPERS up here next year. That's who needs to
you
be
so
talking
much.
about this, not us.
Yeah,
So.
please join me in thanking these wonderful speakers.